Good morning and welcome back to another edition of the Weekly Market Note here at Main Management. Hope everybody had a good Thanksgiving. As usual, I'm Alex Varner, head of research alongside
James Maxwell, SVP of research.
So let's get into it. Our offerings for ETFs is kind of an evergreen slide in there. On the performance side, no red. There was some talk that November was going to end the month down, break the streak of 6 months, and no, it pulled it out. On year to date, S&P is up 16.6. Emerging markets and Euro stocks up the most, 31 and 29.9. So those continues the outperformance of international. Within the U.S. sectors, Infotech leads the way up 23.1. Interesting, you're seeing utilities up 19.7. And then healthcare, worth noting, had a very, very strong month, up like 9.3%, which is one of its strongest monthly returns since they kind of started tracking a while, at least on the sector spider product side of things. Recession dashboard, not a ton change from last week. Again, the kind of absence of data. Now we're starting to have it come back out. So at the end of this week, we get some core PCE spending numbers. We might have an update with that. Going forward on the PPI data, so we did get some inflation data here. This is from September, so very out of date. And from what we've been told, we will not be getting October numbers. They'll basically just draw a straight line from September to October and kind of assume nothing changed. But the headline PPI up 0.3 month over month, rebounding from an unexpected 0.14% dip in August. The year-over-year figure basically unchanged at 273. Core PPI was up a little bit more muted, around 0.1%, kind of half of forecasts for a 0.2% rise. Year-over-year figure slowed to 2.58, which is the smallest since April 2024. These are kind of good, benign inflation numbers, certainly strengthen the case for the Fed to, well, it certainly makes it the bar, makes it easier as we get the kind of employment numbers. The odds, I think, are at 87% for no change in December. Or is that back down to one cut?
I think the odds are that there is a cut in December now after last week.
Okay.
You had, or last couple of weeks, you had a number of Fed speakers kind of come off more
dovish. That's
more
right.
dovish.
Yeah.
So yes, certainly this more benign inflation reading.
And that's I'm getting confused there. But the odds of the cut were down to 42%, so less than half of the odds, and now they're back up to 87. So markets are back pricing in one cut come December. On the goods and services side, goods were definitely more responsible for the PPI figures. They were up 0.95% month over month, biggest increase in September of 23, and the year-over-year figure is up to 3.32%, and that's the highest since February of 2023. So clearly you're seeing some feed through on the tariffs here on the PPI, the producer price index. We'll see if that gets passed through the CPI going forward. Again, you've heard all this talk. Even if it gets passed through, it's a one-time increase. But still, kind of waiting to see on the overall figure is really solid, any kind of solid impact, I guess.
Yeah, one thing too that I was reading about, obviously we had the CPI for September come out actually during the government shutdown. It was, I think, one of the only, if not the only, data point that was that came out during that shutdown because of necessities around kind of price adjustments. What you're able to do when you have the CPI and the PPI is both of those have kind of these underlying components that feed through into the core PCE, which is the Fed's preferred inflation measure. That comes out this Friday. So we'll see what that ends up kind of looking like. Using the PPI and CPI, it looks like it's going to be about a 0.2% month over month reading, which again points to kind of just another benign reading. Nothing kind of hugely inflationary there.
Yeah, and we'll look through on that. You can see the PCE for goods and services, so we'll see if there's similar dynamics to this. But the services were basically flat month over month. They had some increased volatility the last couple of months on those monthly figures, but they're down to 2.54% year over year, which is the slowest reading since February of 24. So really kind of, more benign readings in the services, while the goods have clearly been trending higher. On the retail sales side, again, back to September data, they were up a relatively meager 0.16% month over month, less than forecasts, half of forecasts for a 0.4% rise. You can see they're kind of decelerating on the month over month. Year over year has been trending sideways at 4.26%, basically. Core retail sales, which are ex autos and gas, were up a similar 0.11%. Month over month, that's the smallest gain in a few months. And again, also missing forecast for a 0.4% reading. They slowed to 4.16% year over year, which is the smallest gain since November of 24. Again, they're 4 months in a row of spending. I
Yep.
think this is kind of, you'll see, and again, we probably won't get the October reading, but maybe November, December.
Yep.
So far, some of the reports we've seen were kind of expecting slower retail sales, and we really haven't seen that. I think over Thanksgiving, Kim cited on our call this morning that the numbers were better than expected
For Black Friday
Yeah.
and Cyber Monday, the
Yeah.
whole kind of spending weekend.
and those will come out in the November reading, which we'll get who knows when at
Yep.
this point.
Yeah.
But this kind of should be starting to come back on a more normal basis. But the point being is that the spending so far on the holiday side of things has seemed as fine.
Yep.
Looking through at the categories, miscellaneous stores were up 2.9 month over month, and then gas stations, which were up 2.0. Month over month laggards were sporting goods down 2.5, and then clothing stores down 0.7. And then on a year-over-year basis, you have miscellaneous stores really leading the way up 8.2, and then kind of bars and restaurants up 6.7. It's good to see continued strength in those as people are going out. And then on the year-over-year basis, there's only 3 categories in red, and it's sporting goods, building materials, and department stores down 0.2, 2.4, and 3.3 respectively. So, good to see the vast majority in those year-over-year readings being positive still. On the durable goods orders, so September durable goods came in better than expected, up 0.5% month over month, call it, versus forecast for a 0.3% rise. August was revised up to 3 from 2.9, so good reading there. On the right, there's the non-defense capital goods ex aircraft, which is a mouthful, but that basically translates to core capital goods. Those are viewed as a business spending proxy. Those were up solid 0.9%, really kind of the third consecutive monthly gain in a row and 4th out of the last 5. So it's good to see those kind of posting solid gains here, which kind of is encouraging on the business side of things. On the year-over-year basis, they all decelerated a bit. And again, this is kind of, just the way the comps fall, but they're all continuing to be in their upward accelerating year-over-year trends, which is good. Total durable goods are up 7.6 year-over-year. Those core capital goods are up 4, and X transport slowed to 3.6. And then on a dollar basis, you can see on the right there, they're starting to trend higher. What is it? The X transports are at their highest level ever. Durable goods have some spikes, but if you kind of remove some of that volatility, they're basically at all-time highs. And then core capital goods are kind of working their way back up there. So solid spending on this good side of things for the last couple years here, at least. On the sentiment side, things are not so rosy. This continues to kind of baffle. But the Conference Board's Consumer Confidence Index fell to 88.7. That's the lowest since April. The present situation ticked back down to 126.9, and expectations fell back to 63.2, the lowest since April as well. That labor market differential, which is the delta between jobs, the percent of respondents saying jobs are plentiful, less the percent saying jobs hard to get, ticked back up or ticked back down. I guess it's kind of been, a little unchanged the last 2-3 months here, but you can see it's in that solid downtrend. But again, it's still above the median, and we'll see if this thing kind of starts to bottom out. But from the release, consumers are more pessimistic about business conditions 6 months from now. Mid-2026 labor market expectations remain negative. I think household incomes expectations were deteriorated after kind of 6 months of solid readings. And something worth noting here, and you can say a little bit more on this, but the level of that kind of labor market differential at this point employs if you look at kind of historical deltas, it implies a 5% unemployment rate, whereas the official numbers we're saying are 4.4 now. There's some, again, the kind of, when you get so skewed, there is some.
It's not exactly 1-to-1, but this is something we look at is like, you look at the correlation between this kind of index, looking at how consumers are viewing the labor market. Again, it's percentage of people responding that jobs are plentiful minus percent of people responding that jobs are hard to get. So kind of seeing overall how plentiful or hard jobs are out there. And that kind of difference very, very closely tracks the unemployment rate over time. It's one of like the highest correlation data points out there with the unemployment rate. And yeah, it is kind of implying that the unemployment rate would be higher typically at this level of kind of differential. It's hard to read into like that is a forward-looking indicator, but purely showing that like there are areas of the labor market that look cooler than the headline implies.
And to be fair, this this is obviously a sentiment measure. It's
Yes.
a
Yeah.
polling question, and with the sentiment numbers being as bearish as they have been,
Yeah.
it does make sense. We're constantly like, why are people so, kind of
Yeah.
just reporting that they're unhappy? And so it would make sense that this is maybe a little bit more pessimistic than is
Yeah.
historically implied relative
Yeah.
to the official data.
Yeah, there's a lot of things out there talking about why sentiment is so poor. I mean, this report, for example, lined up right with the government shutdown, so I know that was
Part
quoted
of
as quoted as kind of a part of it. But certainly there's a lot of pessimism out there.
Yeah, yeah. In summary, that's it's a relatively short data week. Holiday, Thanksgiving shortened as well. But those September PPI figures were benign. We'll get the core PCE at the end of this week, as we mentioned. Retail sales also pretty muted, slightly below expectations, but the fourth straight monthly gain. The durable goods orders were up better than expected, with solid growth in core capital goods. And then consumer sentiment, which is that conference board figure, fell back to its lowest level since April. Again, labor market and income expectations kind of weighing on that. This week, we get the RCM TIPP, which is a lot of acronyms, but that's an Economic Optimism Index, import and export prices, services PMIs. We get the challenger grade job cut announcements, and then core PCE income and spending on Fridays is definitely the biggest data point we get, given that's the Fed's preferred inflation measure. And we'll see if and how kind of the expectations for a rate cut change or don't change depending on that figure. But that's kind of the long and the short of it. Thank you for joining us, and we hope you're kind of getting back into the swing of things after the holiday weekend. Take care.
Thank you.